Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're touching a bit on financial results coming out of the manufacturing sectors. And of course, we're talking today, of course, about WCO as well as National Flour Mills. Both groups would have recorded fairly contrasting results or financial performance for their half-year periods ended June 30th, 2025. Let's take a look at how both groups would have performed and what investors might expect ahead. Turning firstly to NFM, well, for its half-year period ended June 2025, as mentioned, the group would have recorded an earnings per share figure of 19 cents per share, which was an impressive 11.2% improvement from the 17 cents odd per share recorded in that prior half-year period of 2024. Now, driving that performance was an increase in revenue, fairly modest, of about 2.7% from 253 million to 260 million, or just over 260 million rather. However, this was commendable in itself, given the fact that NFM would have made a conscious decision over the past 12 to 18 months to actually cut prices and pass through the benefits of lower commodity prices and input prices to consumers overall. So eking out a fairly modest revenue gain despite those revenue decreases, of course, so that would be a feather in the cap of NFM and of course positively viewed by the investor community as well. Overall, operating profits up 11.8% from 26.5 million to just about 29.7 million, and profit after tax ultimately increasing that 11.2% from 20.5 to 22.8 million. When we take a look at revenue trends for NFM, well, as we would have mentioned, there was a conscious decision during that 2024 period to reduce their product prices to the market and to consumers to pass through those benefits of lower commodity and input prices, which NFM was facing after a fairly inflationary period with elevated commodity prices from 2022 onward. And we can see that for the half year of 2024, their revenues would have declined at 12.4% again, but for the half year of 2025, that revenue figure would have increased just about 2.7% from that 253 to 260 odd million. Equally impressive would be NFM's operating efficiency as reflected by their operating or profitability margins. And we can see that for the half year 2025 period, gross profit margins would have actually increased from 28 to 31.5%, with operating profit margins increasing from 10.5% to 11.4%, and ultimately profit before tax margins also improving from 10.3% to 11.1%. Again, what does this mean for investors? It means that for every dollar of revenue generated, NFM is doing a better job of converting that into profits for investors and shareholders alike. So one of the issues, or one of the observations with respect to NFM has been as a somewhat inconsistent dividend history. And as we can see over the past 5 years in relation to those fiscal years, there has been somewhat of a sporadic dividend announcement and dividend payments. And for fiscal 2024, it remains to be seen when and what quantum of final dividend would be paid for that period. Of course, fiscal 2023, a 10 cents per share dividend was declared, and that was only paid in October of declared and paid in October of 2024. So perhaps in the last or final quarter of this period, we'll probably see some more announcements related to dividend payments, if any, with respect to NFM as we move towards the end of the fiscal year. Now, at $1.60 share price, NFM is trading at a price-to-earnings ratio of 4.1%, well below the sector average, 4.1 times, well below the sector average of 10.6 times, and offers investors a fairly attractive dividend yield of 6.3%, slightly above that sector average of 5.1%. So with modest revenue growth in mind and improving margins, a relatively attractive dividend yield, notwithstanding some sporadic nature in terms of dividends. So investors will be keenly looking for more consistency in dividends. Bourse is maintaining its market weight rating on NFM for the time being with a positive outlook given the improving profitability and operating efficiency. But turning very quickly to WCO, Western East Tobacco Company Limited, for the half-year period ended June 2025, the group would have reported an earnings per share of 14 cents, which was a 56% decline from the 32 cents per share recorded in that prior comparable period. Now, revenues would have slipped quite considerably and continued its downward trend, 25% from 255 million to just under 191 million for those first 6 months of 2025. Gross profits down 39.4% from 162 to 98 million. Overall profits for the period declining that 56.9 odd percent from 79.7 million to 34.4 million. Now, when we take a look at the revenue story for WCO, it has certainly been challenging for a fairly protracted period of time. As we can see, revenues for the first 6 months in the half year of 2021 was 411 million. However, that has consistently declined, falling to its current level of 191 million, roughly an over 50% decline from 2021 and a 25% decline from that 255 odd million in 2024. So certainly not good reading, and consistent and persistent rather revenue challenges for WCO over the past several financial periods. We can also see that there has been some deterioration in operating efficiency, or consistent deterioration in operating efficiency. There was some level of stabilization in terms of profitability margin, particularly gross profit margins between 2023 and 2024. However, in the most recent period, that has deteriorated from 63.5 to 51.5%, with continued declines in operating and profit after tax margins. Most recently, operating profit margins 23.6% from 41.7% in the prior comparable period, and profit after tax margins also deteriorating to 18%. From 31 odd percent in that prior comparable period. And of course, WCO was once one of the most reliable dividend paying stocks on the Trinidad and Tobago Stock Exchange. That has changed considerably given the revenue and operating challenges that the company has faced. And we can see that reflected in terms of their dividend payments, with, for example, the first interim payment for fiscal 2025 being 10 cents per share, which was 50% of what was declared in that fiscal period of comparable period of 2024 of just about 20 cents. And you can see that 10 cents per share in terms of the first interim dividend has been fairly just about 75 odd percent lower than what would have been accustomed to be being paid and received by WCO shareholders. And of course, with continued revenue and operating challenges, that dividend could come under further pressure as we move into subsequent quarters. So at a price of $4.32, WCO is trading at a price to earnings ratio of 8.3 times, which is below the sector average of 10.6 times. But again, take this with a grain of salt. This is on a trailing 12-month basis, and further profitability challenges, revenue challenges, etc., could lead to an increase in that PE ratio relative to its price, and it offers investors a relatively attractive dividend yield of 13.2% compared to that sector average of 5.1%. Again, take that with a grain of salt, given that there could be material changes to the dividends declared and paid by WCO in its upcoming period. So, with revenue challenges in mind and narrowing margins, Bourse is adjusting its rating to market weight with a watch outlook for the time being with respect to WCO. But that's it for this week's edition. For more information, you can give us a call at 226-8773 or to Bourse. Email us at info@boursefinancial.com. And of course, you can check out our website, bourseinvestment.com, where all of our research is absolutely free. And of course, you can catch this article in today's business section of the Trinidad and Tobago Guardian newspaper. So until next time, stay safe, happy investing, and we'll see you again on the Bourse Report.